On one hand, though, the thing that I thought was a little funny and I snickered a bit was that the way they allocated the recommendation
I still am getting a lot of questions from people about gold and Bitcoin and the fact that gold is up 50% year to date. Bitcoin's up 33. If you go back a year, right, obviously Bitcoin has doubled the performance of gold. You go back 5 years, Bitcoin is 10x the value of gold or appreciation of gold. But I do think that there is this like short-term momentum focus, especially on Wall Street, of like this year, gold is outperforming. Should I buy gold instead of Bitcoin? How do you think about like looking at short-term momentum versus maybe the longer-term trends where Bitcoin's really been outperforming?
I think both are durable allocations investors must have, and there are distinct advantages and disadvantages to both. But in 2025, the idea of having store of value in your portfolio that isn't dollar denominated is a key story. Even in most financial crises in the past, what you saw was generally the dollar strengthened and investors' flight to safety included dollar-based assets and wanting to save money with US bonds. And that paradigm has fundamentally changed. I don't think people are looking for dollar-denominated assets. That's why gold is actually so powerful in its outperformance and noticeable by even Americans. And Bitcoin, I think, is part of that narrative. The difference there being that Bitcoin still hasn't found institutional flow the way gold has. But institutional flows can just mean different things for retail investors finding allocations for. Gold is, to be honest with you, very hard to store, right? I know it's easy to buy GLD, the ticker, and have allocation to gold's price. But one of the things people have called on for years, even the most diehard gold bugs, is that GLD is not gold because it's an IOU that once you feel like you need it at the exact moment of its tail risk, it may not be actually available and it could just evaporate. And in that sense, that challenges the idea of custody, right? The idea of self-custodial ownership, to which anyone who owns Bitcoin, I think, will find that aspect much easier to do. Of course, there's still the Bitcoin ETF that is a parallel comparison to GLD, but it's much easier to buy Bitcoin and store than actually buying bullions and trying to find a safe box and put it through and hope you don't get robbed. So I do think eventually, like, people will see there are different benefits to Bitcoin too, where it's actually pretty useful from like a velocity of transaction and velocity of transfer perspective. I think institutions, once they see that, will also find this to be a much more efficient way to actually store wealth. And we're just at the very, very early innings of that story. So gold's success is good for Bitcoin. I have always shared with people that we must root for some success of gold to the outcome that we're driving about self-sovereignty. And then the journey advances once people realize that there's different trade-offs to which Bitcoin can outperform even gold. And I think what we're seeing is more of that migration across the mass population psyche.
Very well-respected investors come out and talk about this. We saw Ken Griffin come out and say that individuals are de-dollarizing their portfolios and they're inflating asset prices. Paul Tudor Jones was very bullish on CNBC this week, talking about things like Bitcoin and gold and saying he wants to have a position there. We saw Morgan Stanley now say that a 2 to 4% allocation is something that they want to support their 16,000 financial advisors in doing, because they're getting a lot of inbound inquiries. Vanguard now is kind of capitulating and waving the white flag. I mean, you just go through and you're just like, okay, hold on a second here. This now feels like there is no longer a debate about this, that people realize the dollar and bonds are going to have a lot of trouble moving forward, and therefore Bitcoin and gold are definitely benefiting. I also think stocks have become somewhat of a inflation type hedge or a debasement type hedge. But Bitcoin and gold seem to be the ones that people are really latching onto as part of this quote unquote debasement trade.
Absolutely. Absolutely. I think going back to your Morgan Stanley news flow, the part that was really kind of amazing there is, one, I think we've been so excited and wanting to see private wealth management and financial advisors come to embrace Bitcoin as an allocation in what is pushing out the efficient frontier of modern portfolio theory. So that's great news. On one hand, though, the thing that I thought was a little funny and I snickered a bit was that the way they allocated the recommendation was 4% for a bucket that was called opportunistic growth. Opportunistic growth. I thought that was funny. Why? Number one, opportunistic implies as if this is like a temporal event-driven dislocation
that maybe you
might shift now, but then later you'll trace back and buy something else, and it's like an opportunistic thing, like right now, which I thought was kind of funny because anyone who's been around long enough knows this is actually the opposite of opportunistic. It's as evergreen as it comes. It's the store of value. It's permanent. Like you should have that always. There's nothing opportunistic about wanting the best store of value. And then growth, I thought, was also pretty hilarious because growth, again, like financial advisors think about it in terms of like equities versus bonds, like growth in equities because earnings are growing and we're actually inflating the economy with productivity gains and the rise of young people having more children. Like growth is in a capitalism definition is pretty market driven, right? But Bitcoin in growth, I mean, that's not really growth. I would call that kind of value, right? It's the idea of like buying something that you think is valuable to store wealth. Yet again, that isn't really driven by growth. So I just thought it was funny that Morgan Stanley made the move, but they called it opportunistic growth. When in hindsight, I think it should have been called like evergreen value.
Evergreen value, right? Bitcoin is growing and gold is siphoning some of the capital flows from Bitcoin into gold, central banks, all this stuff. But if you think about it the opposite way, if gold is at $4,000 an ounce, imagine if Bitcoin didn't exist. It'd be at, I don't know, 10, right? Or some big, and now again, the market caps. And so maybe you'd say, oh, actually it'll only be at 4,500 or whatever. But just like the fact that you have the fracturing, it's not just about the pure market cap of spot Bitcoin. You then also on top of that have the Bitcoin treasury companies. You have all of the private companies associated with Bitcoin where capital has gone to get exposure to Bitcoin indirectly. Like you start to like stack all this up and you're like, gold may actually be like $8,000 to $10,000 an ounce if Bitcoin didn't exist. What do you think?
All roads lead to Bitcoin, right? In my opinion. That's why people also have said, within the crypto VC industry, like altcoins have been, on the margin great because at some level, those who find success in altcoins eventually allocate some portion back to Bitcoin regardless. Wealth creation leads to Bitcoin as part of the denominator. And so in some sense, gold is also an altcoin in my opinion, because those who make money on gold, especially the young people, will eventually look to diversify and the correlation will not be perfect. And so if you made a ton of money in gold, you have the higher chance of winning allocation from that pocket of money to invest in Bitcoin than from Nvidia or from French government bonds or anything else. So actually, that kind of diversification outside of gold is probably a pretty meaningful trend we'll see. That's why when Tether also launched the product for where there's performance dictated by Bitcoin and gold performance, as one of the first products they're going to institutional investors with, that shows you already the interplay that's possible by kind of widening the mode of people to invest capital into a pool of asset where you're actually being kind of Trojan horsed Bitcoin exposure in the back end.
Paul Tudor Jones was very bullish, as I mentioned, but he said it feels like 1999, just not the end. He kind of felt like we're in the middle of it. You, I think, have a different view as to like 1999 and the feeling of the euphoria and excitement that people have in the market right now. Explain it.
Yeah. By the way, Paul Tudor Jones has been a Bitcoin bull for a long time. And I think long-term, he understands the exact Bitcoin thesis. At the same time, it's hard for me these days to dispassionately remove the Bitcoin narrative from stock market valuation at some level, because I think they are more correlated than people would want it to be. So the first dimension really is recognizing that we're in a totally different public versus private sector investment scheme. In 1999, the US GDP was growing on the back of globalization as a trend, and the debt to GDP ratio was around 40%. It's a healthy market to grow into. Right now it's 120%. We're over 1, right? So that's very different. And then 2, from a fiscal deficit perspective, we obviously know we're now in a deficit, where in 1999, we were actually a net saver. Even though the current account deficit was starting to grow because of the federal surplus, it was still actually a saver economy, which is unimaginable to even think about for most young people today. So that backdrop is already really different. It means that the role of the private economy had been a larger presence in 1999 than I think now in 2025, where most of the kind of financialization of the markets we're seeing is really driven by sovereign flows. So in that sense, this overvaluation and the stretch is not just coming from, I think, the private sector and individual investors. It's really coming from institutional flows. And there's not a more prime example to share on that beyond the fact that the US government is proactively taking stakes in public companies here in this country at this moment. There's more than 5 now, right? And Intel was the first kind of...
Only 10%. Only 10%.
Only 10%. So, capitalism is still very much alive. But to me, like, that is so incomparable to 1999 as a construct. And on the political front, what was happening in 1999 too was, like, again, the beginnings of globalization, right? China was not part of the WTO yet. In fact, the euro currency actually was not really adopted in 1999 either. It would actually take a few more years. I believe it was 2002 when the euro actually was put in the hands of the people. And in 1999, the idea was introduced as an accounting principle. So this is a pre-euro, pre-China WTO, pre-Eastern Europe being part of the Eurozone world, to which now we've shown all of that has not worked. And it's totally being unwound to this particular moment, where I think all of this just shows you, like, there's many other things that are happening at the global level that we have to take into account.
Why do you think now is actually hitting? Is it because we're 5 years after 2020 and people start to feel it? Is there some data point that they're looking at? Like, why is the quote unquote debasement trade now the thing that they're all like, all right, fine, you guys are right?
I think it's happening because the slow buildup to that moment of reckoning has been seeded into our minds over now for a long period of time, really post-COVID and post-Russia-Ukraine war and everything else that's been happening, to show you that the kind of unipolarity of the geopolitical order is a bit at risk. So I don't think people just woke up one day and decided, like, oh, debasement is the thing that we want to focus on. It's been like a steady crescendo of a buildup. And now what we're seeing is just more kind of, I think, authentic embrace by the people and recognizing that it's actually happening. And in a maybe more optimistic lens, what can we do about it? And actually try to be on the right side of history to see that as an opportunity rather than fighting this thing as if there's a solution. I think there used to be a time when people really wanted to talk about, like, how do we cut down Social Security? How do we cut down these things and bring fiscal health? And I think you ask an average person on the street whether this is on people's mind anymore. I don't think it is. People, I think, have accepted that this is, like, actually what's happening. And now it's up to you individually to figure out how to best navigate that for your own personal self-preservation. And I think that ethos is kind of what changed. The other thing with that in particular is, like, it really comes down to the US credit ratings continually being downgraded and now just having also been kind of not been taken as seriously as it once might have been. Like, that, I think that stick is no longer that powerful. So last week, Moody's again threatened that they're going to have another notch of a downgrade, and no one really cares, right? It's actually the French bonds downgraded and no one really cares. Like, it actually is just kind of, I don't know, like financial games in a world where the entire narrative has moved towards, like, industrial production. So I go back to China, kind of, where, like, the thing about China, whether you like them or not, but that they've been very truthful about, is that they're leading by industrial might. It's like real commodities, real production, like putting real things into actual kind of people's hands to build. And so this funny money game is actually becoming less relevant as people are now opening their eyes towards the importance of these true productive capacity, which is why I think on the other side of the debasement trade is the AI trade and all the massive capital that is flowing into what people are hoping will be actually productive utilities. But that great picture is the trend that's, I think, somewhat unstoppable. I joked about a month ago, I put out a little bit of satire, which was that we need to think about risk-free rate having a totally different definition now, and we now have to go around and tell everybody and call it the risk-full rate to start really normalizing that idea. Like, the risk-free rate of the dollar hegemony is obviously kind of the thing that's at risk, and if you embrace that to now be considered risk-full rate, well, there's a lot of other things I'd rather bet and take risk than trading US bonds. And I think that's what we're seeing. People are taking more risk on the risk curve because if the bonds are unstable anyway, and that premium is not worth it, then there's tons of other things you'd rather be doing.